Welcome to Accounting Fundamentals Module 1, Constructing a Balance Sheet. In this module, we have several objectives. The first one is to explain the format and the layout of the balance sheet. Then we will learn how to record transactions. And finally, you will be able to prepare a balance sheet based on those transactions. Let's get going. The financial statements are a record of the financial activities of the business. There are three main financial statements: a balance sheet, an income statement, and a statement of cash flows. Let's start by reviewing the balance sheet, also referred to as the statement of financial position. The balance sheet shows what a company owns, referred to as its assets, what it owes, referred to as liabilities, and what it's worth, referred to as equity, at a particular point in time. The income statement, also known as a statement of profit and loss, or statement of operations, shows what a company has earned as revenue, what it has paid as expenses, and what the resulting profit or loss is over a certain period of time. The statement of cash flows, or cash flow statement, shows the actual cash movements of a business. It shows how much cash the company has brought in and how much it is paid out, organized into three categories: cash from operating activities, cash from investing activities, and cash from financing activities. Now, in this module, we're going to focus on the balance sheet in more detail. In order to understand what makes up a balance sheet, we need to define a number of terms. Let's begin with the asset side of the balance sheet. Assets are things that a company owns. This includes cash in the bank, furniture in the office, and equipment and technology that's used to create goods or services. Assets are organized into two groups. The first is current assets. Current assets are assets that are expected to be used within 1 year's time. They include things like cash, inventory, and accounts receivable. The second category is non-current assets. Non-current assets are expected to last more than a year's time and include things like property, plant, and equipment, technology, patents, trademarks, etc. Non-current assets are typically grouped into two categories: tangible and intangible assets. Tangible being those that are physical, like property, plant, and equipment, and intangible being those like patents and trademarks that are not physical. By totaling the current assets and the non-current assets, we arrive at the total assets of the business. This forms the left side of the balance sheet, which must equal the right side of the balance sheet. Moving on to the right side of the balance sheet, we have two categories: liabilities and shareholders' equity. Liabilities are what the company owes. And just as with the asset side of the balance sheet, those liabilities are broken down into current liabilities, those that are due within 1 year's time, and non-current liabilities, those that are due in more than a year's time. Current liabilities typically include accounts payable, which is the amount owed to suppliers. Whenever a company purchases something on credit, it results in accounts payable. Most suppliers provide anywhere from 30 to 90 days as their terms for payment. So a company will have an accounts payable balance that is expected to be paid off typically within 30 to 90 days. On the non-current liability side, things like long-term debt, which would be any loan that's due in more than a year's time, are recorded here under non-current liabilities. By adding together all of the company's current liabilities and all of its non-current liabilities, we arrive at the total liabilities line on the balance sheet. The shareholders' equity section is what the business is worth after all liabilities have been paid off. At the beginning of a business, the shareholders' equity is equal to the amount that's initially invested in the company. This is referred to as shared capital. The investors get common shares in exchange for providing money or capital to the business. Then, over time, the balance can go up or down as the company either earns profit or records losses. If the company produces a profit, that net income flows into shareholders' equity as retained earnings. Those earnings can be retained and remain on the balance sheet, or they can be paid out in the form of dividends, which reduces retained earnings. If losses are generated, those also reduce the retained earnings account. So retained earnings is essentially a running total that shows how much profit the company has generated, less any losses, and less any dividends that have been paid out. At the end of the day, the total shareholders' equity value must be equal to the total assets minus the total liabilities. We're about to start constructing a balance sheet, but first it's important to flag that a balance sheet by definition must always balance. What that means is that the total assets side of the balance sheet is always going to be equal to the total liabilities and total shareholders' equity side of the balance sheet. In order to make sure that's the case, accountants have developed a system of recording transactions on two separate places. This is what's known as double entry accounting. This ensures that the balance sheet is always working. There are two options for doing this. The first option is to record any transaction on both sides. For example, if a company uses cash to pay down debt, the asset side of the balance sheet goes down on the cash balance, and the liabilities side of the debt owed also goes down by the same amount. So the balance sheet still balances. The other option is to record a transaction twice on the same side of the balance sheet. What that means is if this time a company uses cash to buy an asset, we record it twice on the asset side. Cash goes down as an asset, but whatever is purchased makes the assets go up, so cash goes down and property, plant, and equipment goes up, and the balance sheet still balances. Now we're ready to start building our balance sheet. In order to build it, we're going to take the following transactions, record them, and see how the balance sheet gets constructed. So here are the transactions we're going to record. The company issued shares for $100 in cash. It took out a 4-year bank loan of $50. It bought equipment and machinery for $80. It purchased inventory for $60. It later sold that inventory for $90 in the same period. It paid salaries of $20, and it paid interest of $3. So now the question is, how would the company record each of these transactions on the balance sheet using the double entry accounting method we discussed earlier? Let's look at what happens when a company issues shares for $100 in cash. The first thing that happens is the company's cash balance increases from 0 to 100. This is recorded under current assets. Now, we either have to record another transaction on the liability and equity side of the balance sheet, or a negative on the asset side of the balance sheet. In this case, we record 100 under common stock under shareholders' equity. This could also be referred to as share capital. Now, based on these two entries, the balance sheet balances, with total assets of 100 and total liabilities and equity of 100. Now let's consider what happens to the balance sheet when a company takes out a 4-year bank loan of $50. The company now owes $50 to the bank, so we can record this as a non-current liability because it's due in 4 years' time. If it was due within a year, it would be a current liability. The proceeds from the loan come onto the balance sheet as cash, so we now have a total cash balance of $150, 100 from the common stock and $50 from the loan. Now the totals on the assets side and the liabilities and equity side balance at 150. Now we're ready to move on to the next transaction. Let's look at what happens to the balance sheet when a company buys a piece of equipment for 80. First, the company's cash is reduced by 80, so it goes from 150 down to 70. The offsetting transaction for that is that the company now has a non-current asset of equipment for 80. On a typical balance sheet, this line item is called property, plant, and equipment, or PP&E for short. Now that we've made those entries, we sum up the totals and we see that the balance sheet continues to balance. Total assets still equals liabilities and shareholders' equity. Now let's look at what happens to the company's balance sheet when it purchases inventory for 60. The first transaction that we can record is reducing cash by 60. This is the money that's used to purchase the inventory. We then have an offsetting entry, which is another current asset that goes up, so inventory increases by 60, cash reduces by 60, and the net effect is that the balance sheet continues to balance, where total assets at 150 equal liabilities and equity of 150. Let's see what happens to the balance sheet when the company sells the inventory for 90. First, the company's inventory drops to 0. The original 60 is all sold, so nothing is left. Next, the cash balance goes up by 90 because the products were sold to customers for 90. If the customer purchased them on credit, then an accounts receivable balance of 90 would be created instead of the cash balance going up by 90. As a result of selling this inventory, the company has made a profit of 30. It generated revenues of 90, which was what it sold the inventory for, and it had costs of 60, which is what it purchased the inventory for. So the net result of that is 30 of profit, assuming no other costs. We should point out that revenue can also be referred to as sales or turnover. The cost of sales line item can also be referred to as cost of goods sold. Profits belong to shareholders, which is why we record this net result of 30 in profit under retained earnings. We can now sum up the total shareholders' equity of 130, which, when we add to the 50 bank loan, results in 180, and the balance sheet balances again. Total assets are 180, and liabilities plus shareholders' equity are also 180. What happens to the balance sheet when the company pays salaries of 20? The first thing is the cash balance reduces by 20, so it goes from 100 to 80. Salaries are an expense just like cost of sales, so they reduce the company's profit by 20. This means the company's earnings reduce from 30 down to 10, and therefore the total shareholders' equity balance becomes 110. When we add up the totals on both sides, we see that the balance sheet once again balances at 160 on each side. Finally, let's see what happens to the company's balance sheet when it pays interest of 3. The first thing is the cash balance will reduce by 3 since interest is an expense and cash is going out. Then, on the income statement, interest will be recorded as an expense of 3, which reduces earnings by 3. The reduction of earnings lowers retained earnings by 3, which then in turn lowers the total liabilities and equity by 3 down to 157, which matches and balances with the total assets of 157. In our previous examples, the company bought and sold its inventory for cash. In practice, though, companies usually buy and sell goods using credit rather than cash. Accounts receivable is the term used for amounts that are owed by customers to the company. So when a company sells products to a customer, and the customer uses a credit card to purchase those products, there is an accounts receivable balance since the company has not received the actual cash for the good yet. Similarly, with accounts payable, when the company buys inventory from suppliers, it often receives credit terms, meaning it doesn't pay for that inventory with cash immediately, but instead gets, say, 30, 60, or 90 days to pay the supplier for that inventory that it purchased. The question we want to answer now is, what would the balance sheet look like if the company used credit when it's sold its goods, and if it used credit when it purchased those goods? So specifically, let's look at what happened if it bought inventory for 60 on credit rather than cash, and additionally if it sold the inventory for 90 on credit rather than cash. Let's work through that exercise together now. If the company sold its inventory for 90 on credit, it records the sale of 90 as revenue at the time it makes the sale. Now, however, instead of increasing cash by 90, the company has an amount owed to them of 90, which it records under accounts receivable. So instead of cash going up, accounts receivable goes up. Accounts receivable is typically recorded under current assets, as we expect to receive payment within 1 year's time. If the company initially purchased its inventory on credit, it would record an inventory increase of 60 and then a reduction of 60 when the inventory was subsequently sold. So the net inventory balance is still 0. Because the inventory has not actually been paid for with cash, an accounts payable balance of 60 is recorded under current liabilities. Since this expense is recorded under accounts payable, cash is not reduced by 60, as it would have been with a cash purchase. Accounts payable is typically classified under current liabilities as it is expected to be paid within 1 year's time. After making all these adjustments, we see that, as always, the balance sheet continues to balance.